Income tax 2023-2024, the Earned Income Tax Credit, the EIC with no children tax software example. Get ready and some coffee because we need to know a lot of information to do income tax preparation 2023-2024. Here we are. First, a word from our sponsor. Yeah, actually, we're sponsoring ourselves on this one because apparently the merchandisers, they don't want to be seen with us. But that's okay, whatever. Because our merchandise is better than their stupid stuff anyways. Like our Crunching Numbers is my cardio product line. Now, I'm not saying that subscribing to this channel, Crunching Numbers with us, will make you thin, fit, and healthy or anything. However, it does seem like it worked for her. Just saying. So, subscribe, hit the bell thing, and buy some merchandise so you can make the world a better place by sharing your accounting instruction exercise routine. If you would like a commercial-free experience, consider subscribing to our website at accountinginstruction.com or accountinginstruction.thinkific.com. In our Form 1040 example problem using Lacerte tax software, you don't need tax software to follow along, but if you have access to software, great tool to run scenarios with. You can also get access to forms, schedules, instructions at the IRS website, irs.gov, irs.gov. Standard starting point here, we've got Adam Taxman just trying to avoid a dang tax man living in Beverly Hills, 90210, starting at the single filing status, no dependents to start off with. We're going to have W-2 income beginning at the 100,000 standard deduction for a single filer, that 13,850. That gets us to the bottom line of the income statement, part of the income tax formula. Taxable income 86,150, which we can mirror in our formula in Excel. 100,000 income minus the 13,850 standard deduction gets us to the taxable income 86,150, tax calculated then by the software on page 2 of the Form 1040, line 16, 14,266. We're now going to be looking at the Earned Income Tax Credit, which is the biggest example of a refundable type credit and the use of the tax code, not as a way to collect taxes, but rather as like a welfare or safety net type of program. That's why we see the Earned Income Tax Credit down here in the payments section. Now notice I put some green check marks next to the child tax credit here, the child tax credit down here, and the Earned Income Tax Credit. That's because oftentimes these two things are kind of linked together. The additional child tax credit as well as the Earned Income Tax Credit are the credits that are typically in the payments section due to the fact that they have a refundable component to them. In other words, most credits are going to be up top here, remembering the difference between a credit and a deduction. Both are good for taxes, but if you have a deduction, it will typically be somewhere in page 1 and part of the calculation of the taxable income, lowering taxable income. But if you got a dollar credit, that will not result in a dollar deduction or reduction of taxes or a dollar increase in the refund or the amount due, but rather decreasing a dollar of taxable income, which will have an impact on the taxes in alignment with the tax bracket calculation. Whereas if we have a credit, whether it be a credit up here or down in the payments section, typically we're going to get the full dollar of benefit, lowering the tax liability by the full dollar. Now, however, if this tax liability goes to 0, then you would think that you can't go below 0 with a credit, because then it wouldn't be a tax. It would rather be a benefit or welfare type of program. And that's why these credits up top will not bring the tax liability below 0. But the items down here could bring the tax liabilities below 0. That's why they're in the payments area. So remember that the payments are usually what are withheld in W-2 withholdings or estimated tax payments. And if we compare that to the tax that was paid or the tax that is incurred, if we paid more, which hopefully typically is the case, we result in a refund. The credits down here act in a similar fashion as the payments, in that if the credits result in a tax refund over, even though the liability is zero, we still might get a quote refund, even though it's not really a refund in that case. It's more of a welfare or benefit type of program. Now, that's going to be the general idea. Now, remember that the earned income tax credit is liked by economists for one reason and also not liked for other reasons. One good benefit of the earned income tax credit is that it actually goes up as you earn income, which is thought to avoid the problem of welfare programs, which actually lock people into being dependent on the welfare program instead of giving them a leg up to be independent from the welfare programs, because when they start to earn any income, they could lose all of the benefit from the welfare program, which means they don't have an incentive to earn income once they're locked into the system of getting government benefits. The earned income tax credit is designed to try to help people to earn income, so the credit actually could go up as the income is earned up to a certain point. The downside of that is it becomes quite complex to calculate, and we're talking about basic tax returns for lower income people, so they're probably not as sophisticated on tax calculations. This is one of the most complicated taxes there are, this credit here, and it has weird implications with regards to the tying of children to it. So the children will have a big impact. That's another reason that we kind of tied these two together, which makes sense because they're trying to benefit, especially single family, probably mothers are going to be the major benefit group, but it also could result in behaviors that would increase the number of children, such as having more children, or possibly filing statuses could be impacted as well. Meaning, if you're married, in some cases you might think it has a negative impact from being married to being single with the way it's calculated, which you would think would not be the kind of incentives you would think would be the generally good incentives. It also leads possibly to the child's being in more hostile custody situations that could be geared towards money or benefits rather than who wants to take care of the kid or something like that. So those are some upsides and downsides of it. So let's break it out basically with 0 kids, 1 kid, and then 3 kids. So remember the idea is that if you have 0 children, you can still get this credit, but it's going to be a lot lower. The max is $600. If you had 1 child, it could be as high as $3,995. 2 children, $6,604. 3 children, $7,430. But there are income limitations. So right now we're just going to look at the 0 children and then look at that. Where can we max out to get that $600? So obviously, if we had 100,000, that's going to be way too much income to generate the credit. So let's go back on over and imagine that we had income of just like 15, let's say 10,000 of W-2. Well, first, let's say zero of W-2 income. So we don't have any income. Well, that means that we're not going to get any credit because it's an earned income credit, and it actually goes up as we earn income. That's part of the incentive. It's trying to incentivize people to have some earned income. So let's say that we have some earned income of 10,000. So now we're going to go back on over and say, okay, now we have the earned income credit that is up to $583. So note that that is interesting and important to note for lower income individuals, because a lot of people that have income of on the low side, say like $10,000, might say, I'm not going to file my tax return because I don't need to, because that $10,000 is below the standard deduction, and you might not be required by law to file a tax return in that case, because the IRS isn't going to come after you because your income is below a certain threshold that you're not going to have any tax that will be owed. However, you might still want to file the tax return in those cases because, number one, you could have had withholdings of this $10,000. So In other words, you're required to have a W-4 form or what, and then if they withheld anything, like if they took $1,000 out, then we're going to say then on page 2, the only way you're going to get that money back is in the format of a refund, that you're going to receive that back. Now, sometimes that will happen if, for example, you worked for part of the year, because then they would have over withheld on the W-2s, annualizing your income, and you have to withhold more given the annual income. And then you only ended up earning $10,000, right? So they over withheld. So that's one thing, one reason why you'd still want to file the return, even if possibly you're not required to. The second reason is that you might qualify for some of these credits, like the refundable credits, even though your tax liability is 0. Those include the refundable portion of the child tax credit, which is the additional child tax credit, and the earned income tax credit, which could be substantially larger if there are children tied to it, which we'll talk more about later. But even if there are no children tied to it, you could have some benefit for the credit. Now, note that you can check this out by looking at resources on the IRS website, and it'll have calculations to see if you qualify for the credit, or if you're filing before the extension due date, then typically you might have access to free software, which you can also find on the IRS website looking for free file options. That software typically provided by third-party software providers, but accumulated on the IRS website, so you can kind of search there, and you might as well check it out, right? If it's free to check it out, and you're thinking you don't need to file, but you might benefit, or you know someone in that situation, you might want to check it out. I would definitely always check it out. All right, so that's going to be the general idea here. So then we can see how it's calculated on this little worksheet. So earned income credit worksheet A. So enter your earned income form 1040 blah blah, and then it says look up the amount on line 1 above in the earned income table to find the credit. Enter the credit here. So if I close this back out, remember that when we looked at this table, it's showing us the maximum credit could be $600, and then it maxes out once your income goes above the $17,640 if single, $24,210 if married. So now we're going to say, okay, so let's look at this table here. This is the actual table, and see what that actually means. So in other words, if your income is between these thresholds and we have no children, this is the column that we're looking at. So the income isn't going to max out. I mean, the credit's not going to max out to $600 until we have income of about $7,800, right? So if I want to max out this credit, I have to have a minimum threshold of income of the 7,800. So let's check that out. So if I go back on over and let's say I go below that to like 6,000 of income. So 6,000 income, I'm going to remove the withholding so we can just look at the credit. So now I only have 461, right? And that ties out to this table here where we had 461 because I had 6,000 of income here between this column. So then if I bring it up to max it out, we've got the 7,850, let's say. So I'm going to say, all right, 7,000. If this goes up to 7,850, then I'm going to go back on over and go, okay, now it's at the 600. Now, how far can I go before it starts going back down again? So I look, okay, it's at 600 all the way up to till I get to 8,800. So I can go, okay, 8,800, and it's still at the max of 600. If I go over that, as we saw with the 10,000, it's going to go back down. So I'm going to say, all right, then we could go here. What did I do? It's at 600, and then it's going, once I get down to, it's still at 600 to 9,800. I can go up to 9,800, 9,800, and So I'm getting confused on where I'm going, and it's still pretty close to 600. But then if I go above that at 10,000, it goes down to 583. So if I go back on over here and say, all right, now we're at 10,000. So now it's going down to 583, and then it goes down, down, down until we reach that 17. So you're still getting the credit, but when I get to the 17, we said the max was 17,650. Right there, it goes to 0. So you could still get the credit at like 7. So that's why this table is a little deceiving, right? So there's the maximum 17,640, but if you're close to that maximum, you're not going to get anywhere near the maximum credit, right? You're going to say, okay, if I'm at 17,350, we're going to say, okay, 17,350, boom, we can go back on over. Now it's only at $20, right? And then it's going to max out. Now note the way this works, or what's this going to incentivize people to do? Yeah, you could say, okay, what is going to happen here? Well, if your income is low, if you only have like 1,000 of income that's W-2 income, then you can't really change the W-2 income, but you're going to say, hey, look, if I could get that income up to 8,000, then I might have, then I can get a higher benefit. So what people could say, well, I can't like get W-2 income unless they they forge a W-2 form that they would send to the IRS, which would be very blatantly wrong if it wasn't true, right? Or they could say, you could possibly say, well, what if I had like Schedule C income, right? Say if I had Schedule C income of another 8,000, then I can say, okay, now on page 1, I've got the 1,000 here. I've got the 8,000 from the Schedule C income, and that brings me up to the 13,000 of, oh, that's the deduction. Still brings me to 0, page number 2. Now it gets a little bit messy here because now I have the self-employment tax that I have to deal with. So notice I get the 600 amount of earned income credit, but in this case, I also would be hit with the earned income tax credit, right? I mean, sorry, not the earned income tax credit, with the self-employment tax. But the general idea is that you can see how people might try to think of ways to manipulate this, right? They're going to say, all right, wait, my income is too low. Is there any way I can try to increase my income to get the maximum to max out the credit? Which, if you don't have any children, is fairly low because you only have the $600. But the credit with one child goes up to $3,995, and with 3 or more children, it can go up to $7,430. That's why the IRS is skeptical about like fraud and whatnot with this credit, because what's it going to incentivize people to do? Misrepresent their income. Either if they're over the limit to maximize the credit, then you're going to have a pretty strong incentive to try to lower it to come into the range to max the credit. Or if you're under the limit, there's going to be incentives to try to increase the income so that you can get a larger credit. And if you don't have any children and you're low income, it could be a substantial benefit to have the child, to be able to have a child on your tax return as opposed to possibly someone else's tax return, because it could substantially possibly, increase the credit. All right, so just to keep that in mind, also note that the earned income for a Schedule C could also be included as a type of earned income when calculating earned income for the credit. Okay, so then notice that if they're married, if a taxpayer is married, let's max out the credit again. So we can say, let's make the credit, let's say we have wages of 8,000. So now I have 8,000 of wages, bringing the credit to a maximum of the 600. So if they get married now you have a married couple. So we're going to say single married filing joint. And so now if I go back on over to Jude, we're going to say now you have Adam and Jane got married now. Let's say they both have combined income of the one $8,000. And then I'm going to say, okay, then they're not going to have any taxable income because the standard deduction is even higher now. And if I go to page number 2, no tax is owed. But look here, it didn't increase the earned income credit, which is kind of interesting, because you would think that maybe it would be doubled in that case, right? Because but that's not how it works, right? The credit is still $600, even that's the maximum credit whether married or not. So you would think if they were unmarried and they both had low incomes, they might be able to get a credit, double the credit, right? Maximum, possibly, you would think. So that's why it's kind of weird, the incentives that it has towards marriage in terms of the credit. Also, the income thresholds to get that $600 isn't exactly doubled, because you'd think if you had two people together, normally they double, like this number maximum you'd think would be doubled, but it's not exactly doubled here, right? So if I increase the income threshold, it's adjusted a little bit for two people. So I can go up to, let's check it out over here. I have the 600 maximized income for a married couple. So with 0, so I'm over here, and it goes down, so it goes down to here for a married couple, and it can go up to 16,400 and still get that $600. So 16,400 for a married couple, and that's pretty close to the $600. And then obviously again it goes back down, and it can go up to 24 before you lose it entirely, as opposed to the 17. So we can increase that. We can increase that, and it would be reduced again as on the married side. Now again, the $600, not really a significant amount, but when we'll talk about future presentations when we add children to it. So then we'll do one for one child, and then 2 children, and then the 3 children, and we'll take a look at those combinations. And we can also think, well, what would happen again if you had 2 people that were not married and then they got married? What would be the incentives with this credit? Well, if they both had 0 kids, the credit would still maximize at $600 instead of being doubled, and their income cannot exactly double. So that possibly wouldn't influence people getting married. It's only $600. But if you have 2 people, one has 0 kids and one has the 1 kid, then you get into situations that now it's basically $3,955. Remember, that's the maximum, whether they're married or single. And if they're single, the maximum amount of income is $46,560. Again, that doesn't go anywhere near doubling to when they're getting married. So you can imagine in that situation, if they get married and now they both have the 1 kid, that you might have a substantial decrease in the credit here, right? And similarly, you can see that extremely if you had 3 kids. Like if you had 2 people that got married and they both had 3 kids, for example, then you would think that would be a pretty big disincentive possibly to get married in that scenario, right? So it's just kind of an interesting structure, the way it works out in terms of, the family structure situation. So we'll take a look at some of those scenarios when we get to the 1, 2, and 3. So it's kind of interesting, and it's something obviously that people would want to be aware of, because it could be kind of a rude awakening or a rude shock to say, "Whoa, my taxes could substantially change from year to year in certain situations." So we'll look more at that later. Also, just want to point out that combat pay is something that you might be able to include in income or not. So this won't come up all the time, but you could see this. And so you're going to say, okay, what if I had combat pay? If it was on the W-2, then it might not be taxable in box 1. but it's going to possibly be in box 12 of the W-2 with a Q for non-taxable combat pay. So let's say we got the $16,400 from there, and that's all the income that we had. Well, then if we go to the forms, we're going to say, well, that's not going to be subject to income because the tax code is trying to give a benefit of not having to include that income in income to lower the taxes, because typically income is bad for taxes. If I go to page 2, we don't have any income, but we don't have the credit too. But we might be saying, hey, look, I want to include it in income because that will give me a $600 credit possibly, or as close to it in this case. So let's go back on over and say we have possibly an option to say, if that's combat pay, I want to elect to include it for the calculation of the earned income tax credit because it actually goes up with income up to a certain point. So if I go back on over, now I still have nothing calculated on page 1, but I see the non-taxable combat pay referenced here, but it's not in taxable income. And then page 2, it's being included to calculate the earned income tax credit. So remember, whenever you're dealing with people in the military, there could be some special rules, and that might be a place of specialization that you want to kind of be aware of those items. Otherwise, it might not come up all the time, but just something to be aware of with that combat pay. It could lead to kind of interesting and weird and somewhat complex scenarios, which again, is kind of funny with these lower income tax returns. Could have a substantial level of complexity related to them because of the complexity with some of these credits, especially the interplay between the non-refundable and refundable components. Okay, so we'll continue on some of these scenarios in future presentations with children involved.